In this example, we are looking at bond conversions. During a bond conversions, we're taking bonds and we're turning them into common stock. So we have the Mendoza Corporation who has $400,000 of 6% bonds outstanding. There's $20,000 of unamortized bond discount remaining on these bonds. And the bonds are convertible at a rate of 20 shares of $5 par value common stock for each $1,000 bond. On July 1st, 2014, bondholders presented $300,000 of the bonds for conversion. So what's happening here is for every $1,000 in bonds, they can change it in for or exchange it for 20 shares of $5 par value common stock. So in this example, in this problem, you're going to have to bring in what you learned from chapter 13. So the first question, it says, is there a gain or a loss on the conversion of the bond, and if so, how much? Well, the first thing we tell you is that there is no gain or loss on the conversion because everything's going to be accounted for at carrying values. So we'll issue the stock, and then it'll be recorded at the carrying value of the bonds. So there's never a gain or a loss recorded when we convert. Part 2 says how many shares of common stock are issued in exchange for the bonds. So the first thing we have to do is we have to take the number, we have $300,000 of bonds, and we have to divide it by the 1,000, because remember, for every $1,000 in bonds, we get 20 shares of stock. So after we take the 300,000 divided by the 1,000, we then multiply it times 20 shares, and so in this conversion, they're going to be exchanging for 6,000 shares of common stock. So from this point now, part 3, we're looking at in dollar amounts. So we want to change it to dollar amounts. How does this transaction affect the total liabilities and the total stockholders' equity of the company? So here's what we have here. First of all, we look at the effects of the bond conversion. So it says that overall the total liabilities are going to be reduced by $285,000 because here's what's happening. Our bonds payable are no longer going to exist, okay? So that's $300,000, so that would be reduced, but then the unamortized bond discount has to be taken into account. So we have $15,000 that's going to come out of our unamortized bond discount. So the total amount of liabilities will decrease by $285,000, which is the carrying value of the bonds. So then we look at the total stockholders' equity will be increased by $285,000 because what's going to happen is we're going to be issuing 6,000 shares times the $5, that's 30,000. So our common stock will be increased by 30,000. But then remember, in step 1 it says that no gain or loss is recorded because it's going to be recorded at the carrying value of the bonds. So that means the difference of the $285,000, which is $255,000, goes to the additional paid in capital account. So what's happening overall on the balance sheet are our liabilities are decreased by $285,000, but our stockholders' equity is going up by $285,000.